much, Shira. Okay. Um, yeah, we are really excited to be back with y'all today. This is our fourth and final session with this group who we've really enjoyed getting to know and getting to talk to over the last few months. And we really hope that by some means we can stay in touch with any of you that would like to. So today's topic for our final session is understanding cash flow planning. And I'll warn you right from the gate, this is going to be a pretty numbers heavy, data heavy, one might use the word wonky, which is just a really technical term for a really nerdy session. So we're going to try and pause periodically to make sure that everyone's with us. But as always, we'll be looking at the chat and making sure that we're cluing in to anybody who's typing in a question, and we'll try and make sure that we pause enough to ensure that you're following with us. And I'm gonna just point out today that it's just Emma and I today. Our colleague Maritza is out, unfortunately, so she is very sad to have missed all of you today. But we'll wish her well from afar. So just a reminder for those who are rejoining us, and for an introduction for those who are with us for the first time, we both represent Nonprofit Finance Fund. Our organization is itself a nonprofit. We work with nonprofits in a number of ways. Emma and I both sit in the consulting department, which, we do a whole host of things, including some coaching and some advising, and then helping nonprofits build financial health and stability. But we also have a lending arm, which we operate out of our community development financial institution. That's the other half of our organization. We've been around for 40 years, so we have a lot of wisdom and experience with our clients and our partners in the sector. And we've developed a lot of this content out of the things that we've learned from nonprofit leaders like yourselves. So please check out our website. I want to say we have a ton of content and a whole lot of thinking that we share there online. And a lot of tools that are pertain to the topics that we talk about in our webinars are available there on our website through those links. And today, as I mentioned, we're going to be doing cash flow. And we would love for everyone who is not interested in talking specifically to go ahead and mute themselves, just so that we can make sure we're concentrating on the right thing. And it's distracting for me too. So just to set up our expectations for the day, we're going to talk through cash flow projections conceptually, but also very, very practically. We'll show you demonstrations of tools that we use and ways to set up cash flow projections as a tool for your planning. And we'll talk about some challenges that we see with organizations that go through this process and how it relates to your decision making. And then obviously ways to mitigate those challenges and to avoid them if possible. And then there will be a brief discussion also just around strategies about managing cash flow, because obviously it's not just a straightforward, you're going to record things in and out and go from there. You also need to keep in mind a much larger picture of ways that you can strategically think about your cash in general. So I think with that, I believe we have one question for you, or two questions actually, before we get started. Before we get into the content, we were just interested, and you can use your chat to just drop in one of the numbers that corresponds to these answers. So the question is, which of these statements best describes you as a leader in your organization when it comes to talking about cash flow? So write down one in the chat if you feel like you know about your budget. Maybe you're even a leader in making your budget, but you don't always understand when money actually throughout the year is coming in or going out. And then write two if you have a good gut sense for that cash flow of in and out of their money throughout the year, but it's difficult. You find it difficult when you're trying to explain that to other people. And then there's an option for number three if you're kind of in the middle of those things. And then I'm going to add a fourth option, which is you actually feel very confident about your knowledge and your handle on your cash flow and your budget and how those things interact. So I'm seeing some ones and some threes, a good mix. There's some twos in there. So I got a four. That's nice. Maybe a two and a four. So there's some overlap here, and that's understandable. We are trying to develop the content around this to make sure that we're meeting everyone where they are. But again, we will stop if you are really pretty new at this. And we're going to invite you to ask questions whenever you need to. More twos and threes, a couple of ones. Okay, great. Thank you for responding. The second question is just about whether your organization uses a cash flow tool. And I'm trying to get it to advance. There we go. So yes or no, do you use a cash flow tool currently within your organization? Or there's an option for if you don't know. So you can either write yes or write no or write, I'm not sure. And yeah, see, so there is a not sure, there's a couple of no's, a couple of yeses. Excellent. So yeah, this will be actually very helpful then. So even if you do already have a cash flow tool, it's always helpful to see new perspectives on it and to get a new look at how to set it up. So without further ado, I'm going to give it over to Emma and let her start the content.
Awesome. Thank you, Sarah. And just a quick reminder, if you can mute yourself if you're not talking or on the question. Thanks so much. And thanks everyone for answering those quick questions. I feel like it's really helpful to inform our presentation today. And I'm going to start off with a little bit more of like foundational about cash flow and more conceptual. And then we'll actually look at a cash flow tool together and kind of walk through the numbers and get really nitty gritty with it, like Sarah said. And then I'll pass it off to Sarah, who's going to go over more of strategies with managing the cash flow and debt and all of that fun stuff. So if you've been on our prior webinars before, you're probably very familiar now with this diagram, this graphic. And we like to use this diagram when talking about nonprofit financial health. It kind of shows us what a healthy financial model can look like and how cash flow operates in this context. So let's look at the business model first, which is that little orange bar. And your business model is reflected on your income statement or your statement of activities. And this aspect of a nonprofit's finances has to do with how it makes and spends money in service of its mission. So it's the day-to-day financial operations, it's the revenue or income, and the expenses or the costs. And so your business model is operating month to month, week to week. And when your organization has a healthy business model, which means it's consistently bringing in more money than is going out, then it can generate surpluses or profits. And surpluses can be saved or reinvested back into the organization and build up its capital structure, which is reflected on your balance sheet. And so the balance sheet is a snapshot in time, revealing the results of the financial decisions an organization has made. And the balance sheet tells us what the organization owns, so its assets, and what it owes, its liabilities. And cash is just one example of an asset. And the balance sheet tells us how much cash we have on hand at that certain point in time. And so a strong balance sheet, one where you own more than you owe, can allow the nonprofit to then reinvest in its business model, meaning it can keep building its operations year over year. And you can see here how cash flow ties into all of this. So the business model operations affect the balance sheet each month because you have new cash balances. And your balance sheet tells you how much cash you have on hand. And as we all know, cash is crucial for being nimble and adaptive, for navigating challenges, managing risks, and pursuing new opportunities. So a cash flow projections tool comes in and takes this all into account by looking at cash coming in and cash going out on a weekly or monthly basis to show us if there will be enough cash on hand to actually pay the bills at various points over our fiscal year. It tells us how long you can operate without reimbursements if you have a lot of government contracts. It helps spot issues early on, like if you project you won't have enough cash one month to pay your bills on time, and it can help you plan and identify actionable steps so you're more prepared. And so when we talk about cash flow and cash coming in and cash going out, this is different than when we talk about revenue and expenses, depending on the type of accounting your organization uses. So I'm going to talk about the difference between cash accounting and accrual accounting. So cash accounting is simpler and more straightforward. It measures cash coming in and cash going out as it's received or spent in real time, as reflected in the bank account. And we typically see this form of accounting in smaller, maybe younger organizations. And accrual accounting, on the other hand, is more nuanced. It can be more comprehensive. It measures revenue when it's earned and expenses when it's incurred. So for example, if you received a grant agreement for $50,000, you would record that as revenue in accrual accounting, even though that cash has not physically entered your organization's bank account yet. For expenses, you may have been invoiced, which would be recorded as an expense, even though you actually haven't paid the invoice yet. So in accrual accounting, revenue and expenses are not the same as cash. And so for a cash flow projections tool, and so for a cash flow projections tool, you only want to record when money is actually coming in or going out of your bank account, which is not always the same as revenue or expenses. So for example, that actual cash from that $50,000 grant agreement might come into your bank account 2 months after you've signed that agreement. So cash isn't entering your bank account until 2 months later, even though you've already been notified you received the grant. So another example is maybe you've been invoiced in the month of January, but you're not planning on paying that invoice until February. So in this case, the cash in your bank account won't be spent or go out to pay that invoice the same month you received it. Cash will be spent in February, a month later, and your cash flow tool should reflect that cash going out in February. And so when we talk about cash flow, we're talking about cash physically leaving or entering your bank account. And so once again, just trying to explain the difference here between these different forms of accounting versus cash in and cash out. And I know this can be a little bit confusing, so I'm going to pause here and see if there are any questions. There is a question about the training being recorded, and the recording will be shared later. But feel free to come off mute.
So far, so good.
But feel free to come off mute in the chat if you have any questions. We love to hear from you, and this can be sometimes more of a confusing topic.
Hi, I'm driving, so sorry for not raising my hand. I wanted to know if there are, because I do a supportive role at my organization, and I'm wondering if there are kind of soft introductions or like basic nuts and bolts about the different types of accounting. I don't even know which one we utilize, because again, I'm new and I do a support role, but I'm wondering if there are any like introductory stuffs. Thank you.
Thanks for asking that question. Well, one, I would start by asking your finance team what type of accounting you all do. Sarah, I don't know if you have any ideas for basic intros into the different forms of accounting. I'm not familiar with any training.
Yeah. Do you just mean, do we have internally at NFF any content about it? Or is there just, you're just asking generally about content available anywhere?
It could be both. But if you have
Yeah.
stuff that's developed in specific, wonderful. If there's more high level, broad stuff, that's great too.
Yeah. I'm gonna check our website real fast and I might respond in the chat. I know you're driving, so that might be hard for you to read right now. But I don't want to hold us up too long. But I know I will point out one thing is very important for everyone to understand. NFF, we are not accountants. So we might have some limited information about it on our website, just as it pertains to, that accounting does touch a lot of what we do. Since we sit in a more strategic position and we're thinking more about like planning tools. We try not to wade too much into accounting since we are definitely not qualified as we are not accountants. But I will say there is, I'm sure, a lot of thinking online about the differences between cash and accrual accounting. And I'm happy to take a quick glance and drop some links to places that I know to be reputable sources into the chat. So if you can access the chat later when it's safer for you to do so, I'm going to drop some things in there that you can check on your own. So hopefully that's helpful.
Yes, thank you. That's wonderful.
Great.
Thanks, Sarah.
I have a quick question, guys. Hi. My name is Hortensia. I'm here at Life Center up in Redding, California, and I am very new to this position. I started February 1st, and this is my first time being in one of these meetings. But you said that this is the fourth installment of meetings that you have already met 4 times. Can I find the prior videos, the prior 3 videos?
Yes, you should be
Okay.
able to, Shira, not to call you out, but she's leading all of that with the
Okay.
resources. But yeah, all of the
Okay.
presentations and recordings should be available to you.
Perfect. So then I can watch those and then get
Yeah.
caught up, and then it'll all make sense, hopefully. Yeah. Okay. Thank you, guys. Thank you.
Yeah, of course.
So sorry, a follow-up to that is I think I've been asking about recordings, but I've been emailing, but I haven't seen it. So, okay, great. I see Shira commented in the chat. Thank you.
Okay, great. Thanks everyone for raising that though. Any more questions before I move on to the next slide? Okay, awesome. So diving back into cash flow, a cash flow projection measures cash coming in and cash going out and breaks it out on a monthly or weekly basis, depending on how nitty-gritty the organization needs it to be. And so, for an example, during COVID, we saw a lot of organizations monitor their cash flow on a weekly basis since there was so much change and fluctuation week to week. And a cash flow projection is a visual landscape of cash flowing in and cash flowing out, so you can better understand your organization's ability to tolerate risk. It tells you if you have enough cash on hand week to week or month to month to meet future needs. And if you don't, it helps identify and plan for those gaps and periods in your year where cash may not be flowing in and what you may need to change or adjust. And cash flow projections allows you to think through scenarios. So for example, can we cover X if no cash is coming in this month? Can we cover Y with what we think is coming in? And lastly, just to clarify the difference between cash flow issues and cash issues. So cash issues is when money is not on the way. For an example, an organization that lost a major funder that they rely on to cover the bulk of their expenses every year. So that organization would either need to find more funding or cut expenses, and that's a cash issue. A cash flow issue, on the other hand, is a temporary lack of cash due to timing of cash coming in or cash going out. So for an example, an organization that hosts a major gala each year in the spring may have a cash flow issues in the beginning of their fiscal year until they receive those donations and income from ticket sales in the spring from that gala. And then they may be flush with cash for the remainder of the year, but might be tight in the beginning before that gala and the major donations hit. And so last webinar, we talked about budgeting. And so you may be wondering how cash flow projections differ from a budget. And there are a lot of similarities. A budget is a plan for the fiscal year. It's a roadmap and a financial plan with a set of priorities and dollar amounts attached to working towards those goals. And a cash flow projection tool is also a roadmap, but it's broken out into smaller increments of time, so monthly or weekly, like you've heard me say a couple times now. So it takes those goals from the budget and projects when we can expect cash in and cash out across the weeks or months of the fiscal year. So after you have a board-approved budget, we typically see organizations begin to project their cash flow for the next fiscal year. So for accrual-based organizations, this is an exercise that compares the cash you expect to have with the expenses you must pay for. And we'll be taking a look at a cash flow projection tool in a couple slides so we can look at a real concrete example. You can also think of the connection between the budget and the cash flow projection tool like an accordion. And so the budget is when the accordion is closed, it encapsulates all your priorities and goals for the entire fiscal year, like all clumped together. And then the cash flow projection tool is when the accordion is wide open and so fully extended, and each fold represents those weeks or months where you're looking at the cash flow. And so what information do you need for a cash flow projection? You need to know your starting cash balance at the beginning of your fiscal year. So for instance, if your fiscal year is on the calendar year, January to December, your cash flow projection tool needs to start in January. Having your past and current budget, your previous profit and loss statements are all really important. Reviewing these documents and asking yourself, what did we plan for this year? Looking retroactively at what changed year to year and what trends you're seeing can all help inform your projections as well. So for example, if you know from prior years that your gas bill is due the first Wednesday of every month and your water bill is due every other month, this will help you project when cash is coming out and how it will impact that month's cash bottom line. And so knowing details about the cash, including the amount, if it's restricted, if it's unrestricted, and the timing is all important when projecting. So if you have a government contract and are supposed to get reimbursed in June, but know there's always delayed wait times around 60 days for reimbursements, don't project the reimbursements until August. So I know this can be challenging, but being cautious and more conservative when projecting cash flow can better prepare your organization. And so also, just as a reminder to be in contact with your program officers so you understand what the turnaround time is for reimbursement can be helpful, when you should be invoicing, so you can more accurately estimate these timelines in your cash flow projections tool. Also, knowing the anticipated demands for services. So this is the case for organizations with earned revenue. For example, if you're an arts organization who puts on performances each year, knowing when those performances will be and thinking through how that will impact your cash flow is also a really important consideration. And the next few slides, we're going to deep dive into the cash flow projections tool and get into all the numbers. But before I do that, I want to pause and see if there's any reflections or questions on this more conceptual concepts I just talked about. Okay, great. So now let's take a look at a very basic example of a cash flow projection tool. And you can add more layers and nuance, which we'll review in a bit, but the basic structure is still the same. And so in this example, we're looking at a monthly cash flow projections tool with January 2024 listed in the first column and then February 2024. So we can see that this organization has a calendar year, fiscal year from January to December. And the basic components of a good cash flow planning document include the beginning cash balance, which we see at the top row here. So we see that's listed at $120,000 for January 2024. It shows us the resources that we have on hand at the beginning of each month. Below the beginning cash balance, you will see several cash sources, which should line up with your revenue and other support line items. So for this organization, we see under cash in, they have admission ticket sales at $40K and then a foundation grant at $110K. And once again, these categories should reflect that cash coming in the month of January. So for this organization, the month of January, they received $40K in admission and ticket sales and $110K in foundation grant. Then we see the total cash in line, which adds those two together at $150,000. And below the cash in section, we have cash spent, which includes payroll at $90,000 and rent at $40,000, which is an insane amount of rent for 1 month of January. And then the total cash spent, which just adds those cash spent line items together. So 90 plus 40 gives you 130. Then we have net cash in or cash out, which just takes your total net cash. So your total cash in was 150K minus your total cash spent, 130K, 150 minus 130. We get that 20K net cash in this case, since it was positive, which just means in the month of January, this organization had a surplus of cash, an additional $20,000 of cash because they had more cash coming in than cash going out. And your ending cash balance is just your beginning cash balance plus your net cash in or minus your net cash out. And so in this case, once again, this organization had positive $20,000 coming in. So $120,000 at your beginning cash balance plus your $20,000 net cash in equals $140,000. And you'll notice here that the ending cash balance goes to the top at the beginning of the cash balance at the beginning of the month. So they ended January with $140,000, which means they're going to start February with $140,000. Any questions? I know sometimes when people start talking numbers and you're not physically also seeing them written down in real time, it can be a little confusing. So I just want to pause here and see if there's any questions.
No questions. This is Keith Wilson at the center. Oh, I want to get back closer to my camera. The nuance here with cash flow planning as opposed to accrual accounting is that payroll is reflecting the pay dates. So it could be like a December payroll paid in January, and that rent, since we pay rent before the following month, we might be paying for February rent there. So in accrual accounting, it would show up in the February books. And in January, it'd show up in on our cash accounting, it would show up in January. So just something I see a lot in the EYC reports, difference between accrual and cash. I like this example a lot. Thanks for showing it.
Yeah, of course. Yeah, and when we talk about, like I said at the beginning of that, the difference between accrual accounting and when you're looking at your cash flow projections is that cash actually coming in that month on that day, you're actually receiving that in your bank account, and then your cash going out, once again, that's leaving your bank account. So anyway, thanks for sharing, Keith.
And I'm going to jump in 1 second because I just realized we don't point this out, but Keith raises exactly what's going on, and it's helpful for those of you who might not be sitting in a finance part of your organization. If your organization does have a finance team and you do accrual accounting, they're likely making this translation to cash whenever they're talking about your projections in this way. There's a statement of cash flows that accrual accountants have to do to translate everything back into cash. So there's all this math that goes behind the work to kind of pull it back to a cash basis. Even when you do accrual accounting within your organization as a sort of larger method, they're probably still retranslating that information back into a cash basis at some point, whether they do that monthly or yearly or whatever it is. You can probably ask them about it, and they, I bet, would love to tell you all about it. So yeah.
Thanks, Sarah. Okay, now we're gonna add a little bit more complexity and take a look at separating unrestricted and restricted cash. So if you've had restricted funding and want to closely track releases, and by that we mean funds that were available but funds that were restricted but are now available to use because they've met a timing and or purpose requirement. And so this added layer may be helpful, so you know what's flexible and available to use versus what's restricted to your purpose or programs and or timing. So to start the process of separating unrestricted and restricted cash, you'll see that we have added an additional line at the top of the template. We now have two beginning cash balances, one for total cash that includes all cash, and in this case it's at $120,000 in January, and one for unrestricted cash only, and that's at $100,000. And we just highlighted there in that purple box. And so to allow us to track these two balances separately, we have also added a section called cash with restrictions below our original template. So you see that right here.
I'm in a meeting.
And let's walk through this again so we can understand how this all works together. So starting with cash balance without restrictions, we see revenue from various sources totals $120,000 cash coming in without restrictions. And this includes that $10,000 of net assets released from restrictions. And this is what I was referring to earlier. Net assets released from restrictions is just an accounting term. And once again, it just means those restricted funds are now available for use because they have met a timing and or purpose requirement. And so for this example, for this case, let's just use the example that, $10,000 was released for a youth education program. The organization knows that they need to use it in the month of January. So that timing purpose was met and $10,000 of that grant was released in the month of January. So now let's take a look at cash spent. And we see the total cash spent is $130,000. Once again, payroll and rent, same as that last example, totaling $130,000. And you can see the first gray line, net cash without restrictions, totals -10. And this is where we see the kind of like added layer of nuance. So how do we get that number? We're just looking at the without restrictions section. So the total cash in without restrictions is $120,000. minus $130,000 of total cash spent, and we get that -10. And this is the net amount of cash that either came in or came out that month. And once again, in this case, $10,000 went out in January. We get the ending cash balance without restrictions by subtracting from the beginning cash balance without restrictions. So $100,000 minus $10K, the net cash without restrictions, which equals an ending cash balance without restrictions of $90,000. And this becomes the beginning cash balance without restrictions for the month of February. Then looking at cash with restrictions, we see that $40,000 is coming in, and then we have -$10,000, which moved to the cash without restrictions section, and they're just there to balance each other out. So that's already been released and accounted for, which means we have a net inflow of cash with restrictions of $30,000. And here's where it can start to get a little confusing. I'm now going to walk through how we get the total ending cash balance. And so total with restrictions and without restrictions. And the hint here is just to look at your net cash lines. So if you add net cash without restrictions, which is that -$10K, plus your net cash with restrictions, which is that +$30K, you get a total net cash positive of $20,000. And if we add that to the beginning cash balance from the top, which was $120,000 in the month of January, we have an ending total cash balance of $140,000, which once again is a combination of that cash with and without restrictions. Okay, and now we're going to add another layer of complexity with separating out operating versus non-operating. And when we say non-operating, we mean items that are not core to your organization's business model and are irregular and more one-time in nature. And so separating out operating versus non-operating cash enables organizations to differentiate between the cash sources and uses that are part of everyday operations from those that are irregular or special in nature. And so an example of this is a capital campaign, which we see listed here below the bottom line, and that's highlighted in that blue box there. And this non-operating activity will also be reflected in the organization's budget. And it will also be placed below the line to separate it from your reliable, day-to-day, reoccurring operating revenue and expenses. And so separating out operating versus non-operating may not be relevant to you or your organization. We're sharing this in the hopes that it may apply to some of you and may be applicable to some of you in the future, if not right now. So now let's take a look at how all of this interacts and works in real time. So the top line is beginning cash balance again, which is all cash. And once again, it's $120,000 for the month of January. Below that is the beginning operating cash balance without restrictions, which again is $100,000 for the month of January. And right below the operating section, we have cash with restrictions right here. And we just collapsed it all together because so you can all see these numbers hopefully a little bit more clearly. But we can see that the total there is $30K. Meaning we had $30,000 coming into our organization this month with restrictions. And then below that in the light gray section highlighted with the blue border, we have non-operating activity. And we see a capital grant and a capital project expense. These are non-operating, so when they spend or receive money for their capital project, they record these items below the line because once again, it enables this organization to differentiate between cash that is part of everyday operations from things that are irregular, episodic. And so some other examples of non-operating revenue and expenses could be funds received to purchase capital items like new computers or vehicles. Non-operating revenue could be like a one-time large donation gift that you're not expecting to receive again. But taking a look back at this example and the numbers, we see the result for this organization's non-operating cash in is $10,000. They received $50,000 in the month of January for that capital grant, but they also spent $40,000. So 50 minus 40 gives that 10K. So the total net cash activities for the month were negative 20K from operating cash without restrictions, plus $30,000 from cash with restrictions, and plus $10,000 from non-operating sources. So this totals a positive $20,000. So when added to the beginning cash balance of $120,000, we end the month and begin the next month with $140,000. So once again, we're looking at those total ending cash balance, looking at the net balances and adding or subtracting them all up, depending if they're positive or negative. We'll give you the numbers there. I'm going to pause because I know that was a lot of information and once again, a lot of math without you all like physically seeing it. So just going to see if anyone has any questions or reflections. Feel free to drop them in the chat or come off mute. And thanks, Sarah, for answering the question in the chat about cash with and without restrictions.
Again, so far so good. I'm following. I have my paper version right here. So far
Awesome.
so good.
Okay, great. I'm going to move on, but once again, feel free to interrupt at any time to ask any questions. And so this is just a snapshot of one of our cash flow planning tools in Excel, not to plug, but we will be sharing this along with some resources on our website that are all free and available. But overall, you see that this is the same structure as the examples we just walked through. The first column is actually the budget, so you can compare your budget with your monthly cash flow projections. And at the top of the document, you'll enter the beginning cash balance in the first month of the fiscal year. So this organization's fiscal year is the same as the calendar year. So their cash flow planning starts in January. We also see that unrestricted cash is separated out from restricted cash, with unrestricted cash listed at the top, since it's more flexible and available to use. And then next we see that non-operating cash is also separated out from operating cash, and is listed once again below the bottom line, since non-operating activities are episodic, irregular, and aren't core to the organization's business model. So you don't want that to inflate your picture of what your cash looks like. And lastly, the bottom of the document shows us the total ending balance, which once again, the total ending balance will go to the next, will be the beginning of the cash balance at the beginning of the next month. And now I'm going to pause here and ask if you all can tell me the beginning total cash balance for February. So if you are able to get out your calculator or your phone, and if you can drop in the chat or come off mute and share either the total ending balance for the month of January or the beginning balance for February, since those numbers are the same, and then we'll kind of all walk through it as a group together. So I'm going to pause here and give you all a couple minutes. Thanks, Sarah, for that reminder. Yeah, the first column is the budget in gray. January 2024 is the column that you all want to be looking at for finding the ending cash balance. How are folks feeling? Do they need more time? Are you confused? Should we walk through it together? Yeah, feel free to come off mute too if you have any questions or want to share the answer. Okay, we have one answer in the chat at 51,569. Clara also says that. Any other responses? Thanks all for participating and doing math. It's not always the most fun. Ursa, I'm sorry if I'm pronouncing your name incorrectly, says 71,569. Any other responses before we walk through it together? Okay, great. The ending cash balance is 71,569. And let's walk through it together. So awesome job, Ursa. Once again, sorry if I'm mispronouncing your name. And let's walk through it together because this is confusing and there's a lot of different numbers happening. So when we're looking at the total ending cash balance, like I said earlier, looking at those net cash is a nice helpful hint to looking at how to calculate that total ending cash balance. And so when we're looking at our net, let's first take a look at our net cash from operations. And so for the month of January, it was negative $35,000. How did we get that negative $35,000? Just to walk backwards a bit, their total operating cash in without restrictions was $4,000 in the month of January. So they brought $4,000 in. Their total operating cash spent in the month of January was $39,000, $39,431. So $4,000 minus $39K gives you that negative $35,000 since they spent more than they brought in. Then you're going to take that negative $35,431 and you're going to add it to your net cash with restrictions, which is at 7K. And how did they get that number? The cash received with restrictions was $10,000. So $10,000 came in restricted. $3,000 was released from restrictions. So 10 minus 3 equals 7K. So you're going to add 7K plus your negative 35,431. And if you do that calculation, it gives you 28,431. And so that's your total net cash for the month of January. But if we want to know our ending cash balance, we then subtract the beginning cash balance of $100,000 minus that $28,000, that 28,431. And then that should give us the 71,569. Does that make sense? Nancy said, why do you add back the negative? Nancy, would you mind coming off mute and just sharing a little bit more about your question? Or if you can't.
Yeah, I was just asking about the net cash from operations. It shows a negative 35,000 and forgive me if this is I'm sure this is a dumb question, but why do we add that back?
That's not a dumb question at all. That's a great question. And so we get negative 35,000 because we only took in $4,000 from the month. And then we spent $39,000. So
Got it.
4,000 minus 39,431 gives you 35,431, that negative number. And so that's how much cash was unrestricted that month that went out. And so when you're thinking about your total cash for the month of January, you want to add, or I guess subtract in this way because it's a negative number, to also your cash with restrictions. So we're looking at cash without restrictions, which is that negative 35,431. But we also had an additional $7,000 in cash with restrictions. And so to get our total cash balance, we're going to add the negative 35,431 plus the $7,000. And that gives a negative around negative $28,000. And then to get your total cash balance for the month of January, since that negative $20,000 is just how much went out when you're including with restrictions and without restrictions cash. So you're going to take $100,000 minus 28,000 roughly, and you get that 71. Does that make any more sense?
Well, I'm sure I'll figure it out at some point. But to answer your question, no. But I'll figure it out. All right.
It
Okay.
could be, it,
That I don't
it-
want to
if I
spend a whole
can,
lot of time.
no, if I can offer a quick way of thinking about it, it can be helpful to think about it the way your bank tracks your account balance. So when you're looking through, like if you do online banking and you're just looking at your statement even, and you're just tracking through, okay, I started, January with X amount of dollars in my bank account. I deposited X amount of dollars and I spent X amount of dollars. So they're just tracking that addition and subtraction. And then they'll say, okay, well, the total of everything you put in and everything you took out is this at the end of the month. That's the same concept here. So we're adding in the money that we get, and then we're subtracting out the money that we're spending. It's just confusing because when we have these net lines, we're doing that. It's like doing the pre-work. So we're going ahead and adding and subtracting in the sections and then totaling it all together at the end. But really, if you're following just the sections individually, you say, okay, we started with 1,000, we added 1,000, we added 3,000, we took away, those 32, that's 6, that 3, all those little numbers. So you add, then you subtract, and then you add some more, and then you get the total at the end. It's just weird to look at it with these sort of subtotals that are already adding and subtracting some parts of it, but it is just one big sheet of just putting in some, taking out some, putting in some, taking out some. So I don't know if that bank analogy is helpful, but it looks way more complicated than it is.
Yeah, and I think it can also be confusing too of cash spent. So that's cash going out. Is technically you're subtracting that, right, from your bank account, even though it's showing that it's positive in that total cash spent section. But Nancy, was that helpful? Okay. Thanks for asking. I'm sure a lot of other people
That
have
was better. Yeah, that was
Okay.
better. Better,
Good.
yeah. Thank you.
Thanks, Sarah. Any other questions? Great. I saw Keith drop something in the chat. Thank you. Okay, and this slide is really just adding another level of detail by breaking out cash flow into more months to help illustrate a more comprehensive picture of what your cash flow projections can look like over the course of the year. So you see that we've added the February 2024 column and March 2024 column. I'll also add that below each month it says PROJ, and that's just an abbreviation for projection. And so each month we recommend retroactively updating these numbers to your actual numbers of what you actually spent and what actually came into your organization. So you know what actually occurred that month and can update your projections and base them more accurately on real-time data. And so now let's take a look at the numbers again, and we see that the ending cash balances from the previous month becomes the next month's beginning cash balances. So in this case, the ending operating cash balance without restrictions for the month of January was around $44,000. So we see that moved to the beginning operating cash balance without restrictions in the month of February. And then the ending cash balance, so that total ending cash balance, which we just talked about, is $71,000 in the end of January. And that becomes the beginning cash balance, beginning total cash balance at the beginning of February. So at the beginning of the year, we can see that this organization is more flush with cash. But as months pass, we see that their cash is shrinking over time. And looking at this organization's budget, we see that the majority of their funding comes from the government. They have about $425,000 projected in their budget. And so the bulk of their revenue might not come in until the fall. So in the first half of their fiscal year, they need to be thinking about how much cash they need to cover salaries, rent, and other important costs that keep their organization running until those government contracts, that actual cash comes in. You also might notice that the total ending cash balance differs from operating cash without restrictions compared to total cash. And looking at the difference between these balances gives insight into what is or is not flexible and available for use. It also gives insight into potential cash flow issues. So for instance, in the month of March, this organization's ending operating cash balance without restrictions is at negative $793K, whereas their total cash balance at the end of March is $26K. So as this organization gets closer to the fall, when they receive the bulk of their funding, for this example, they may see an increase in cash in. And so the purpose of this tool is just to help you think through and project when cash is coming in, what cash is coming out, and help you think through what months you may need to adapt or change to cover your expenses, because you might be holding off for, cash coming in a couple months later. And so, yeah, it just helps you identify challenges.
Yeah. Okay,
Just a reminder, yeah, thank you to go on mute. But a cash flow projection tool helps you identify challenges before they happen. So yeah, you can plan to the best of your ability to either mitigate or prevent that issue from happening. And Sarah's going to walk through some strategies about how to manage cash flow when you run into these issues. But before I pass it off to them, I want to pause and see if there's any questions around the tool or anything we've shared so far. And I'll just stop sharing my screen so we can all see each other. But yeah, if there's any questions or any thoughts.
Someone said that when we have the slides that the tool is actually included with that. Is there an actual spreadsheet, and does it automatically calculate from month to month? Okay.
Yeah, all the formulas are set in stone, so thankfully, no more math.
Thank you.
Okay, well, if there are no questions, I'll pass it over to you, Sarah.
All right. Yeah. That's like we really recognize that this is just a lot of numbers to kind of digest, and then to also think through like how you yourself are gonna maybe need to use this tool and all of that. But I want to actually kind of back up, or not back up, but go in a slightly different direction just for a second. Because I know that there are likely a handful of people here today that are experienced enough in nonprofit management that you might be thinking, there are times when the problem isn't how do I account for my cash flow? Like, how do I just track it and plan? But rather the problem can be, how do I even keep cash in my organization in the first place? And I want to point out that this slide says strategies for managing cash flow. And we at NFF really recognize that we sort of roll two concepts together of accounting for cash and then building up cash. Both of those concepts are managing cash flow. It's the work of managing it is to not just track it and plan for it, but to build it up to begin with. And I know as a nonprofit leader myself that it is just as important to plan as it is to keep doing the day-to-day work of just maintaining the cash balance you have in your nonprofit. So just to recognize that that's a substantial part of this conversation, that building up the cash in the first place is a whole lot of hard work. But I want to talk through some strategies to build up cash. So firstly, just having a plan for building your business model, so your revenue, your planned revenue, and your planned expenses, budgeting that plan to have a surplus whenever possible, and making a plan to do so. I know that's easier said than done, but having that as a budgeting strategy every single year when you feel like that's a possibility for you, that's a central practice that we advocate that all nonprofits adopt. You can kind of also look at when you're holding events or appeals, so that they land in the year when you most need that influx of cash. So really kind of thinking strategically about the timing of those things, to make it like less likely that you'll see your cash come in from that event or that appeal and then immediately head straight back out the door. So maybe you can put a little bit more of it to work in various ways. We also recommend that you build up really good relationships with any vendors and any lenders you have. This is a really great argument. I'm always telling nonprofits to work with local businesses or local banks whenever possible. They're just more likely to be available to you, and they might be more responsive to working with you as a community member. So they might have, more favorable timing on things or more favorable payment plans that they can give you. And that's just worth exploring if that's not something you're already doing. And then obviously, a really obvious strategy is just to minimize how much your expenses are every year. Obviously, that's going to just decrease the amount of cash that's leaving your organization to begin with. So just keeping an eye on how tight things are and how tight you can make them when you're budgeting for the next year. A more subtle version of building up cash is hanging on to cash. And by this, we just mean, things like building good relationships with your funders, so that you can get on better payment schedules relating to the grants you might be getting from them. And relatedly, you can see if you can get to a point with them where you can just begin the conversation about maybe easing restrictions. So if you have a lot of grants that do have restrictions, sometimes there are conversations to pursue with those funders about whether those restrictions are really necessary, or, making a case for if they were to ease those, that you could, use that cash a little bit more effectively. If you have things like ticket revenue or other kinds of earned revenue, and you end up in a really tight spot, you can consider, and this is just something we point out since the pandemic, consider asking those ticket buyers or the people who have bought into your earned revenue source if they'll consider translating that into a donation. Like I said, bring this up since the pandemic because this was a really effective strategy for a lot of performing arts organizations when the pandemic forced them to cancel a lot of their shows, and they took this tactic to ask those ticket buyers to convert their tickets into donations, and had a resounding, in a lot of cases, a resounding yes, that was fine. And then last, there's obviously the option to borrow cash. This is a good short-term option, a line of credit or a bridge loan. Those can be the helpful kind of debt that you can use on a temporary basis just to get you on the other side of your cash flow issues. And a little bit more about that last strategy. I told you to start with that we were going to talk about debt. So we're referring, like I said, to debt right now. I'm going to just talk about lines of credit and bridge loans, and we talk about those as working capital, since those types of funds are usually injections of operating money, so that regular repeatable is not, unusual. It's an injection of usable, flexible operating money into your organization. And it works kind of like the way an upfront investment into a startup, a startup has expenses that come in advance of its income, and investors know that, so they give working capital to get the funds into the organization in advance of when that dip in cash is expected. A good line of credit is a good option if your organization has more seasonal, sort of predictable cash flow issues, like Emma brought up a couple of times, like you might have a government reimbursement contract, and every year that pays a little later than you would really like it to. So every year you're fronting a lot of the costs for whatever that contract is for. And a line of credit can be a good way for you to fill the gaps between when those expenses happen and when that that grant is eventually going to come in. So more regular recurring gaps. And then a bridge loan can be more helpful for those particular, more specific gaps that don't necessarily recur all the time. Like if you are undertaking a big campaign or some really much larger, more unusual project that has a lot of immediate costs, and you know you have a funding source that will eventually come into play, but it's going to take longer than you have in terms of what you need to spend immediately on your project. So a bridge loan can get you that funding in the near term while you're anticipating the funding that you are seeking in the long term that you know you will have. This is great for, you know, like I said, you do already have a plan for paying what you're doing. You just have a timing issue between when those expenses are happening and when that income is coming in. And one last word about debt as a strategy. Using debt can sometimes give you more to work with on a faster timeline and with more flexibility than a lot of other ways of accessing cash. You can't always cut expenses. You can't always talk to your funders about restrictions. You sometimes you just are up against a brick wall in a lot of those ways. So you might look into some ways of managing cash flow by using these short-term temporary debt solutions. But your organization definitely needs to be ready to complete what might be a difficult process when you take on debt with complicated applications and tricky demands that might be made on you by the people that you're seeking that debt from. There will be a new expense that you'll have to account for in the form of the payments to pay that debt back. And then there's always, and this is something I have personally experienced managing an organization's finances. There's the potential when you have debt for your board, your existing funders, your staff to all be concerned about just the idea of taking on debt. They just not all debt is bad and not all debt signals trouble, but many people associate debt with concern. So if you are planning to use debt as a strategy, you just need to be prepared to address that concern carefully and to talk with specificity about why you're pursuing this as a strategy and why this is a good way to go, because it can be very helpful. And like I said, not all debt is bad. It can be very strategically helpful. And before we wrap up, and I think we're doing great on time, so we might have plenty of time for Q&A. We wanted to share some of the common mistakes that we see in the field, so that hopefully you don't also fall prey to these missteps yourself. Because this is a tricky thing to do. And I flippantly said, oh, it's just not as complicated as it looks, but it is complicated because it is a lot to track and a lot to keep track of, over a long period of time. And there are a lot of important details that go into this work that you do have to be very careful of. So a lot of these are just those details that people have overlooked. And you might remember from Emma's templates that all of them started with a beginning cash balance. And while you can, in any tool that you're looking at for your expenses and your income coming in and out, you'll see those, inflows of cash, outflows of cash, but not including a beginning cash balance makes it really difficult to track the amount of cash you actually have each month in the same place as you're tracking those inflows and outflows. So just double check that you're giving yourself that starting balance to see the whole picture. And it is surprising how many people set up a really complicated cash flow tool and then keep forgetting to enter their beginning balance, which just doesn't make it as helpful as it should be. Another step, an organization will often take an income or an expense, like take, your utilities and just divide it by 12 over the year, which is called straight lining an expense. And that might be a good place to start if you're a little overwhelmed about filling in your cash flow tool, but it's really important to actually account for the variations throughout the year of those expenses as they actually occur. So like take like a school, a tuition might come in at a certain point during the year and then not come in at all for the rest of the year. Teachers might only be paid for certain months and not other months. So straight lining that is just not going to work. I'm sure many of your organizations have a lot of things that are just not the same every month. Like I said, I'm not blaming anyone if that's where you start, but try to when you, and Emma mentioned this actually, try to, when you're going through each month, fill it in with your actuals. And in fact, for the first year, if you're just taking on a cash flow projection tool for the first time, straight lining can be a nice way to get a draft. And then as you go through each month, you can fill in your actuals so that you kind of have a sense of how this goes in real time. Another issue, especially for straight lining, is payroll. Unless you're in your organization's HR department, you might not remember that not every month has the same number of payroll weeks if you do biweekly or even weekly pay. So months with more payroll weeks should be, higher salary numbers. So just little details like that make things less accurate. Obviously, Emma went through a whole lot of detail about separating non-operating cash from operating cash. And I know we went into a lot about what restricted cash versus non-restricted cash is, but I want to just clarify for anyone that's not familiar with that concept of non-operating. I want to go back and explain again. That's any section in your financial world. So any expense or income that is really unusual as compared to what happens for your organization every single year. So my favorite example is, and it's a little morbid, excuse me, but is a bequest. So you might get a large bequest from a donor you've had for a long time. Maybe they were a regular donor, but the year they die, they give you a whole lot of money. That person is not going to die more than once. So that bequest is a one-time thing. You can't expect it to ever happen again. It's never going to happen again. Not from that same person. You might get other bequests, but not from Frank. So Frank is only going to give a bequest one time. That's a non-operating gift. Since it's an unusual, it's not recurring, it's never going to happen again. It's probably larger than Frank's other gifts. So that's a great example of, you don't want to necessarily include Frank's bequest, his gift to you upon his death, in your regular accounting for the rest of your income, since it's going to, when you generate a report for your income for that year, your income's going to look huge, and somebody's going to say, wow, we did really great that year. And you're going to have to over and over again explain, well, that was the year Frank died. So that's why the income is so high, because it was a bequest. And you're going to it's so much easier to just pull that out and say, here's the section that accounts for those unusual, more extraordinary aspects of what happened this year financially. So I hope that makes sense. Let's see, where was I? We've gotten about halfway through. Yeah. So another thing that's helpful to remember is that cash flow projections are often used at board meetings or are provided sometimes to funders or lenders when you're in a meeting with a new funder. They might request something like this. So it's really good if your format makes not just the cash flow clear, but your assumptions behind the numbers clear so that people know where you're getting this information. I will say on the flip side, too much detail might pile on way too much information to allow for them to make an expedient decision about whatever you want them to do. Either, giving your board way too much to chew on, they're going to get really in the weeds, or the funder might start to kind of tickety-tacky pull apart little details that you really don't want them focused on. So finding that right amount of detail can be helpful when you're delivering your cash flow projections to another audience. Obviously, internally, however much detail is helpful for you to keep track of things, but when you need to use it to help someone else make a decision, you don't want their focus to be on minor issues like how much you spent on pencils. Or one of my coworkers' favorite hobby horses on this is postage. She hates it when people track postage specifically. So just keep in mind there's a particular level of detail appropriate for different situations. The other good reminders on this sheet about remembering that cash in and cash out are not revenue and expenses necessarily, that there's going to be complications in your tracking about, you'll be likely receiving cash from last year's receivables. And I think Keith might have even said something along the lines of this in the chat a little while back. So just making sure you're really accurately counting for when actual cash comes in, when actual cash goes out, and not when you just know about something or not when the bill comes due. And then as always, this is a reminder we give for every tool that we teach our clients or our communities about everything we do. Any tool is just, you just want a usable tool. That's the goal, even if it isn't a perfect tool. So don't stress too much on every single penny being exactly where it needs to be. Like most of our tools, this is just to help you plan. If you're spending so much time on getting it exactly right, then you're probably not spending enough time on the actual planning itself. So don't let the perfect be the enemy of the good. Do your best and then move on with your day. And the last thought we wanted to give you today, it's just actually sort of, we went through the what and the how, but I want to return to the why. So when you're building your cash flow projections, what you're trying to do, what you're really doing is trying to get your mind ready for the future. You're readying for decisions you might need to make. You're gaining insights into future possibilities. And you're gathering all that data that you can gather, that you can possibly gather to be ready to know when those possibilities arise and then what decision might be best for you to make. I will say leadership should not be expected to solve any crisis by itself. And I really believe that in all nonprofit staffs, the best solutions to any crisis come from collective thinking and problem solving. And especially when it comes to tools like this, undertaking this process and using it as a decision-making tool should involve the people affected by those decisions. So those are the people who will be, your staff, your board, whoever it makes sense to include, whoever will be affected by the decisions you make within these planning tools. Those are the people who will best be able to help you see how the changes that tool represents, how any of the strategies you undertake, how that will impact the work they're doing. When you're examining your cash flow tool, it should be easier for you to find and plan paths through various outcomes. So I think Emma mentioned earlier that, you can plan for scenarios. You can think through, okay, well, I see in July we might be getting into trouble here. So I'm going to really, work really hard to pursue this new funder that we're cultivating. And I'm not going to waste my time with this other one that I know is just not going to go anywhere. But your cash flow planning tool can be the grounding starting point for building out scenario plans or action plans for whatever you do end up seeing on the horizon within your cash flow. And then last, the data that you gather via your cash flow tool might help you not just like find those plans, but identify what might end up leading you down one path or another. So we refer to triggers a lot in our scenario plans because, XYZ might happen, but it only will happen if ABC happens. So you can, through your cash flow planning, you can pinpoint where those triggers might be or will come that are going to instigate an action or a different action, whatever it is you need to do in response that. And, if you've already done your cash flow planning, you're anticipating when those things might arrive so you can be prepared to make that decision when it comes. So we have some discussion questions as suggestions, but y'all have been so engaged today, and I'm sure that you've got your own questions. So I'll just leave these up for a second, but I'm really curious, like what thoughts you have, or if there are any just, more practical questions or philosophical questions even. So yeah, we'd love to hear from you. I'm gonna try and make sure I've got the chat pulled up. Here it is. Okay.
So far, so good. I've been following. I printed out the budget tool, and it's pretty helpful. Just going.
Okay, good.
Like, as you're reading it,
Nice.
going along with it too. So.
Yeah, good.
Trying, but
I think it sounds like you're succeeding. I think you're past trying.
thank you.
Yeah. Has anybody who may have downloaded the slides in advance clicked on the tool link at the end yet? Just out of curiosity. Okay. I see a hand up. Ishmael?
How you guys doing? I apologize. I've been kind of multitasking throughout this. So if you already stated it, I'll have to watch the
That's
recording.
okay.
But I'm curious to know, what does like the back end Excel sheets look like that help us get the figures of which funding sources are restricted and unrestricted? So I know by looking at a grant, it may say 50% is capacity building and the other 50 is specific to program. How do we organize those funds to know how much of a particular grant we've expended? Like, what does that back end piece look like?
Right. That's a great question. And one that our tool here isn't going to answer. So the cash flow tool doesn't know, it's just as basic, almost entirely just addition and subtraction of whatever you're putting in those categories that you set up. Behind that, you'll do that accounting for where the restrictions are and how they flow. Hopefully you have an accountant who knows how to do all of this. And it can be a little complicated depending on, if your restrictions are kind of multi-layer. Like you said, you have some things that kind of come in for one thing over here and then a little bit over here. That's going to be its own spreadsheet. So, and then I'm sure that's what you were saying, but the math within that will have a lot to do with whatever the donor has set up as a restriction in the first place. So if it's purpose restricted, so which means they gave you money and you can only use it on a certain program, you're probably going to set up your budget and your reporting. So, all the things that tell you the actual money that's coming in and out, all the activity within your organization's finances, those will be set up with a separate section that's going to track that money as it is used or as it is held before it is used. So the accountants that I hope you get to work with are likely pulling in the restricted funding and holding it as an asset. You have that money, but it's not necessarily recognized as revenue. It's not income yet because you can't use it. So until it is, they'll keep it there for you and they'll account for it separately, just totally separately on your balance sheet, which is, sometimes called a statement of position. There's a lot of terms for it, but they'll account for that on its own, and then they'll release, like I think Emma used that word several times, they'll release it from restriction when it is ready to be used, as in that program is about to happen, or if they said, well, you can use half of it this year and half of it next year. Once you get to next year, they'll say, okay, here's your income from that grant. You can use it. We've released it from restriction, but they're going to set up their own tool to manage how that money is kept, where it's kept, how we're sort of remembering that it is there, and keeping track of whether it's for a particular thing or for a particular time. Is that helpful? Does that sort of break it down at all?
Yeah, yes, it is helpful, and I think we are in the process of building like our budget allocation model,
Yeah.
because
Yeah.
our growth as an organization happened pretty quick, very quick. So a lot
Right.
of the intricacies
Yeah.
weren't built out yet. We were just kind of going grant by grant, and then now we have multiple grants with multiple restrictions. So
Right.
it's kind of like, which one do you do first? But I think
Yeah.
it's important for us to address the allocation so we even know how to track. So nonetheless, this was helpful. I appreciate you guys.
Yeah, no, and that's such a common thing. I mean, congratulations first on getting a lot of grants and being able to grow. And it's so common that organizations haven't needed the kind of infrastructure to handle all of that until they have it. And then all of a sudden you've got to build all this infrastructure around it. So you're definitely not alone. And it might be honestly as simple as just keeping, whatever document you're using to track your budget or to track your planning for, your cash flow, however you're looking at it now, just pulling that into its own little section and creating a couple of extra columns. Sometimes it is just that's a good way to start if you haven't gotten started and nobody's done that yet. Or for those of you that have this issue as well and don't know where to start, just pulling a separate column that's your restricted column. So you've got everything else over here, you've got your restricted column, and then it adds up to the totals to the side of that, so that you can see, okay, I'm putting things kind of where they go, but it's all in its own little space in this column just for restricted money so that I don't get everything confused. So it doesn't have to be complicated, but it does take some care in making sure you're putting things where they go and not forgetting that, even if it's all in one bank account, it is not all one kind of money. So, yeah.
Very
Any other
helpful.
questions?
I do
Yeah,
have a
go ahead.
part
Go
two. If no one has a
Sure.
part two, I can come back though.
Let's give it just 1 second and see if anybody else has one, and we'll just come back to you if they don't. Thanks so much for being so generous. Okay, hearing none, come on back.
All right, round two. When
Round two.
do you advise, or what do you, when for a younger growing nonprofit, do you recommend outsourcing accounting, or
Hmm.
like another servicer or company, or doing it internal? Like, have you seen one being more successful than the other?
I wouldn't say more successful. Sometimes a nonprofit has, you know, especially if you're small and you're just getting these things set up, you might have someone, or a nonprofit might have someone on their board who is an accountant who might help in the short term on a kind of, pro bono basis to get these things set up so that it isn't quite as expensive when you do take that on. It's really, we joke around a lot about the fact that the answer to everything is it depends, because it really does depend. If you have enough, if you're having such success pulling in grants and some of that money is unrestricted and it just for whatever you need it for, you might go ahead and just hire an accountant on an hourly basis, just to get someone's help to set these things up, that maybe then you can continue to maintain by yourself if they give you that help up front. But I will point out that as you continue to grow, you might have more need of that service than you will be able to maintain by yourself. But it can be, I think there's a lot more, there are a lot more people working in the field, in the accounting field, on a kind of contract basis than there used to be. So I think there are options that exist that didn't used to exist. But there are a lot of factors that go into that decision. Do you have someone internally who's at least capable enough to manage, like a QuickBooks Online account, or some other software that can help you just keep track of things, even if it isn't totally comprehensive? Or, maybe, like I said, maybe you have a volunteer that can help you just get things set up until you're ready to hire a firm, or ready to hire internal staff, and once you get large enough to support the staff for that. But yeah, it's truly dependent on your own circumstances. There's a lot of answers to that question.
Thank you.
Yeah. I've worked with some great contract accountants, by the way, so definitely don't knock them. Don't always have to be in-house. Any other questions? I think we're right at time, so I'll open it for one more. This is when we're ending, right? Okay, thanks. Okay, I'm gonna show this last slide. That's where I promised you those links. So when you get the slides, make sure you go all the way to the end and click there. And that's the tool. And then there's also a webinar that is very similar to the content we just delivered, that has a workbook as well, if you're just kind of want to really nerd out on the whole thing and get really deep with it. So yeah, thanks so much for your time. I'm gonna stop sharing screen.
Thank you. Have a good day.